Hello and welcome to Portfolio Matters Share Talk. Today we will be discussing the small UK listed mine developer Emmerson, which has a potash development in Morocco. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, over to you.
Okay, thank you, Richard. Now, I realise that Emmerson has quite a large chat room following. So before we get into the discussion of Emmerson, I briefly want to talk about the Portfolio Matters channel for people who have come to this video from the chat rooms. Now, when Richard and I started Portfolio Matters 3 months ago, our aim was really to try and engage with private investors and people who wanted to become private investors and perhaps didn't really know much about investing in the stock market. But actually, that is not our audience. We have discovered our audience over the last 3 months, and our audience is actually pretty sophisticated private investors who we engage with in a very constructive manner, and we have positive engagements with them. So there's nothing on this site, this channel, where we get into arguments with people. We always give our positive and negative, honest advice about and opinions about every stock we cover. And actually, the value in what we do is we cast a skeptical eye over every company. If we were just to be relentlessly positive about every company we cover, then our opinions would have very little value as far as I can see. We would just end up being an advertisement for every company we cover, and that is not what we do. So people on our channel will disagree with us, and they are very welcome to disagree with us. For example, one of our followers, Sunny Days 64, disagrees with us on Sol Gold and has bought some. And we absolutely wish him well with that investment. And more than that, I can't think of any reason why we wouldn't wish him well. Private investing is a difficult game. We want all our members, our followers, to do well out of the stock market. Above all, it doesn't really matter what I think. What matters is what the market thinks. And so when Sunny Days disagrees with us and buys Sol Gold, I really hope it works out for him. The point is that if you disagree with our analysis and you think we're wrong, you are welcome to tell us, give us some information which will make us change our minds. And in the case of Colonial Coal, we were provided with information which made us change our minds. But if you disagree and just give us a load of abuse, then really we're not very interested, and that is not the spirit of this channel. So if you're coming here from an internet chat room, please detox first before putting any negative comments on our comment board. And
I would also add, Keith, that if we review a company and we have negative views about it, and you are positive about that company, it's not a personal attack on you. And as an investor, we all have to be able to take a step back and listen to arguments we don't like. And George Soros, who I think we would all do well to try and emulate, one of the things he said he found most important was talking to people who disagreed with him, because it helped him to understand what was really going on. But with that, I think, Keith, it's time for
yes,
Emmerson.
I think it's time. And as you could probably guessed, we're going to be negative about Emmerson, I'm afraid. But before we get into that, I'd like to thank our viewer, Stephen Psallidas, I think his surname's pronounced, for recommending this stock for us. Unfortunately, Stephen, I didn't like it, but we will go into it. Emmerson have a greenfield potash development in Morocco, which they claim to have an NPV 8 worth about $1.5 billion. And given its market cap is something like 40 million pounds, that makes it look very attractive to a lot of small investors. Okay, so its current share price is about 5.5p, market cap 46 million. It's got about 800 grand in cash. Now, the conclusion is going to be that I don't understand the numbers. And this presentation is going to take you through my intellectual journey as I analyze this company, so you can see why I'm skeptical. And because I'm skeptical, for me, this company is uninvestable. Okay, so this is the share price of Emmerson, and you can see that has a few spikes. And these are the developments over the course of the last few years. So it listed in 2017 at 3p as a shell. And then it acquired this Moroccan development for 10 million, issuing new shares in October 2017, and signed heads of agreement with a fertilizer company for actually the production from the Chemiset potash project in 2019. And then since then, it's raised money, and it moved to AIM on the 20th of March earlier this year. So previously it's raised money at 3.75p, 4.25p, and 5.75p was the last one in February. Okay, but before we get into Emmerson, let's talk about potash. So potash is the generic term for the potassium content of fertilizer. And I didn't know this, but potassium is absolutely essential to plant growth. Its small amounts are used in enzyme formation, and then larger quantities are required for moving water and sugar around the plant. So during the growth phase, plants actually need more potassium than they do nitrogen. So potassium is absolutely essential to plant growth. But potassium is well retained by soils that contain clay. And so you don't actually need that much of it because it doesn't get leached out as long as your soil contains some clay. And work done in Britain at Rothamsted shows the effect of reducing potash concentrations on plant growth. And the bottom line is, if you increase the concentrate of potash beyond a certain point, this dashed line here has no effect on growth. So the plant has enough potash to grow. When you reduce it below that threshold, you get reduced yield. And so, and when it gets quite low, you get very reduced yield. And so another way of looking at it is, as you reduce the potassium concentrations in the soil, so you get lost yield. So all crops require potassium and therefore potash. But the potash market is well supplied. So there was a spike in 2007, 2008, which was caused by rising demand for crops for biofuels in US and Europe, and production problems at the Sylvinit mines in Russia, plus the imposition of export tariffs in China. But as is always the case, there was then a supply response. And right now, the potash market looks well supplied. And you should be aware that this chart shows the price of muriate of potash, which is potassium chloride, free on board Vancouver. And that's important. And the current price is $202 a ton, which is down 23% from the average price in 2019 here. Okay, so in 2020, Mosaic, which is a big potash producer, shut down one of its mines in Canada indefinitely due to excess inventory and poor market conditions. Earlier this year, the Belarus Potash Company, which is a big producer, agreed a new annual contract with India for 800,000 metric tons a year, $247 a ton CFR, which is delivered to India. Okay, so then these two big Canadian potash producers have come out with a statement saying that the agreement between the Belarus Potash Company and India was done at pre-market rates for political reasons. I think they're wrong. I think that shows that the Belarus Potash Company know what they're doing, and they can see that this market is oversupplied. And because there are lots of planned developments by low-cost producers in Belarus, amongst other places. So the commentary I've read says that producer discipline is necessary to maintain prices, i.e. there's oversupply. And up to 23 million tons of new capacity may come online in the next decade, of which 7 million is firm. And you can see here, this yellow dot is Morocco, presumably the Chemiset development. Now, if we go on to the United Nations Food and Agriculture Organization Fertilizer Outlook for 2020, they give the capacity for producing potash as 64 million tons per annum, 64.5 million tons, of which only 49.5 million was produced. So they are saying there is excess capacity of well over 20%, more like 25%. So this market is very well supplied. Now, the other thing you should know about potash is that more valuable is sulfate of potash. And Emmerson are planning to introduce some manufacturing facilities to produce higher value sulfate of potash, which is done by reacting muriate of potash with sulfuric acid at high temperature using the Mannheim process. And this would mean capital investment of 97 million by Emmerson. Like, I noticed that they're saying the capital cost would be 97 million, which is 119 million, including 30% contingency. But again, the numbers don't add up. 30% added to 97 million would be 126 million. This is the Mannheim process. Okay, onto the company. So this is where they are. They're in Morocco, and they are close to Casablanca, would be their main export terminal. And they make a big thing of the relative attractiveness of a Moroccan development compared to a new Canadian development. The big things are that there's no aquifer, so you can do an extraction using a decline rather than a lift, which is much cheaper. There's infrastructure already in place with a highway. You don't need to put in rail, and there's an existing port, and then your shipping to Brazil is much cheaper. They're saying $24 including royalties compared to $105 for shipping from Canada to Brazil. And this is a schematic of what they plan to do. And you can see there's this gentle decline to the salt layer, which means that they can put in conveyor belts to get the salt out. And they are saying that CFR Brazil, i.e. delivered to Brazil, chemisett would be right at the lower end of the cost range compared to other potash producers. And this chart is important. So what they are saying is a lot of the relative attractiveness of the development in Morocco are because shipping from Morocco is substantially lower cost than shipping from Vancouver. So if we take you through the route to Brazil from Vancouver, from the mines in Saskatchewan, it's costs $25 a ton in royalties. Then there's $45 a ton to move from rail from the mine to Vancouver, and then costs you $30 a ton to get the shipping, the ore from Vancouver to Brazil, plus $5 to go through the Panama Canal. Whereas the route from Morocco to Brazil could just cost $10. So in total, including the trucking from the mine to port and royalties, delivery cost from Morocco is only $24 a ton compared to $105 from Vancouver. So that's very substantial. These are the economics. So they are saying that based on a price, this is a conservative price for muriate potash of $280 a ton, and they would produce 700,000 tons a year, plus 1 million tons of gritting salt, and the price would be all in sustaining cost, free on board Casablanca would be $171. And that would get you $166 million a year in EBITDA, giving you a margin of 46% and an NPV of 0.5 billion. If you have a consensus case, and they're saying the muriate potash price would be $360 long term, then that gets you to an NPV 8 of $1.1 billion. And obviously, if the share price is currently 5.5p and the market cap is 46 million sterling, that looks pretty attractive. And this is the time scale, and we are here. So they're completing the SOP, sulfate of potash feasibility study, getting the environmental and mining permits. But a main thing is they've got to raise the debt. And then all going well, they'd start commencing construction later this year. So this is a mine development that is close to starting if they can get the permitting and the finance. So they're currently in talks with strategic equity investors, lenders. They don't have any mining royalty. I take it that is what they mean. They're saying that Argus, who are an independent consultancy, are stating that the long-term muriate of potash price is $412 a ton. Okay, so, and this is from the website, and they are saying that post-tax NPV 8, 1.1 billion, essentially. There's 400 million of capital investment. And this is also from the website, and using the base case based on the Argus Media's long-term MOP price, you get to an NPV8 of 1.4 billion. So you can see why a lot of small private investors are very interested in this stock. Okay, and so that is the company's story. Now we're going to go into why I don't understand it. Okay, first thing to note is that the numbers have changed. So this is the presentation from November 2019. And things to note are that they're then saying they could produce 800,000 metric tons per annum, that the capital cost would be 406, that the all-in sustaining cost at the Casablanca port of Mohammedia would be $147 and EBITDA 236 million. Now, if we step forward to the current presentation, you'll see that the average annual MOP production would now be 700,000. So $100,000, 100,000 tons per annum less than they were saying 2 years ago. The free on board price in Casablanca has gone up from 146 to 171, and capex has also gone up. So all these numbers are moving in the wrong direction. Their conservative cases are based on, and the consensus case are based on, very elevated MOP numbers. Now this chart is the cost of potash FOB, free on board Vancouver. So the cost of rail transport and royalty payments is already included in the price by the time it has got to Vancouver. This is the price actually on board ship in Vancouver. And they're stating that their conservative case is $280 a ton, and then consensus 360. And right now we're down here, we're at 202. And as we saw from the UN Food and Agriculture Organization, the potash market is oversupplied. There's 25% excess capacity, with more coming online, a minimum of 7 million tons per annum coming online over the next decade, mainly from Belarus. So I just can't see how anyone could be expecting the potash price to rise from here. And then the other thing was, so I started thinking about this chart showing the transportation costs. And let's just think about $5 a ton going through Panama, through the Panama Canal. Now, you know that the size of a Panamax ore carrier is around 100,000 tons. So are they really saying that it costs one of these ore carriers over $500,000 to go through the Panama Canal? That seemed extraordinary. In addition, the distance from Vancouver to Brazil is only about twice as far as from Morocco to Brazil. So how come the shipping price is 3 times as much as it is from Morocco? Okay, so how much does it cost to go through the Panama Canal? Well, the internet is an absolutely wonderful thing. And you can go onto the Panama toll calculator and work it out. So a Neo Panamax dry bulk carrier with a capacity, deadweight capacity of 130,000 tons, it costs actually a lot. It costs $277,000 to go through the Panama Canal. And that is, that's a lot of money, but it's not $5 a ton. It's $2.1 a ton. Yeah, big difference. Moving on to the transportation costs, again, there's this wonderful website called Sea Distances, where you can work out the distance between ports. So the distance between Vancouver and Rio via the Panama Canal is 8,267 miles, and using their numbers of $30 a ton, that means each dollar will transport your ton 275 miles. Whereas from Rio to Casablanca, it's at 4,015 miles. Your dollar will transport your ton of ore 401 miles. That doesn't seem right. So what they're saying is it's much cheaper per mile to transfer ore from Morocco to Brazil than it is from Vancouver. Odd. Okay, so then there's this other great website called www.cargorouter.com, where you can try and work out how much it will cost to move a container actually from Vancouver at the bottom here to Rio are from Casablanca to Rio. And you'll see the freight index here, which gives you an idea of the cost, is 5,600. And from Morocco, it's 3,008. So that is a ratio of 1.5, not 3. So the numbers we can verify, I mean, 1.5 does seem quite low to me, but it's not 3. All the numbers contained in the Emmerson report just seem optimistic. And those are the ones we can verify. And it always raises a red flag to me when the numbers you can verify don't look right, because the companies put out a load of numbers which you can't verify, like the all-in sustaining cost. Okay, so let's move on to a rough calculation. Now, bear in mind, we have numbers for the price of muriate of potash free on board right now, Vancouver. And let's use their numbers. Let's use transportation cost, Vancouver to Brazil. So we are taking their transportation numbers as read, that it does cost 3 times as much to move from Vancouver to Brazil as it does from Morocco. But we're going to use our toll numbers of $2. That means that your free on board cost of the ore in Vancouver plus $32 gives you a CFR, a delivered price in Brazil of $234 a ton. Okay, now using their latest figures from the February 2021 corporate presentation, they're saying $172 a ton free on board Casablanca, $10 transport. So their cost for CFR Brazil is $182 a ton. So they're making a profit of $52 a ton. They're producing $735,000 a ton, which produces profits of 38 million a year. Okay. In addition, they're producing 1 million tons of salt, and they are stating that they would sell this in the US East Coast for $60 a ton. This is gritting salt. And Shore Capital states that they could produce this for $32.7 a ton. So that gives you a profit of 27.3 million for the salt, 38.4 for the potash, total 66 million. Okay. But let's be conservative. Okay, so again, using their transportation numbers, but let's say that they are adding supply to this market, and in order to get market share, they're going to have to undercut Vancouver. So they're going to have to offer it at a slightly lower price. And I've taken $10 a ton off. In addition, I have increased the transportation cost from Casablanca to Brazil so that the per mile rate is equal to the per mile rate from Vancouver, which makes sense to me. I just don't see no reason why the water should be different going across the ocean. The cost per mile, I would have thought, would be identical. So that means the price CFR comes down to $224 a ton, and the cost CFR goes up to $189. So then the profit comes down to 26 million, total profit 56 million. I've also knocked 10% off the price of gritting salt in the US for precisely the same reason, because they're basically going to supply 10% of East Coast road salt, and that is going to have a result. The other thing I would say is that the freight index, Minsk to Delhi, so Minsk is, Belarus to Delhi, is enormous. So it's basically cost 3 times as much to move potash from Belarus to India as it does to move potash from Casablanca to Rio. And that cost is included in the $247 CFR that the Belarus Potash Company have agreed with India. So what I'm trying to say there is that the $202 a ton CFR, so FOB Vancouver, seems about right compared to the deal done by the Belarus Potash Company earlier in the year. Okay, then we get on to the shore capital calculation of the economics of this development. And they are using $412 a ton. So more than twice the current price of muriate of potash. I mean, I find this absolutely mystifying. I don't know how that is remotely justifiable. They then use transportation costs Casablanca to Brazil of $10. They also use, frankly, this $158, where they're guiding to 172 now. So their FOB price in Casablanca is low. So that gives CFR price in Brazil 168. And based on this 412, that gives $244 a ton profit, which is vastly higher than the numbers we've calculated. And that gives them profit of $179 million for the potash alone, plus $27 million for the salt. That gets to 207. But Shore Capital, who are the tame broker, are quoting EBITDA of 307. And I really just can't see these numbers. How the hell have they got this number? So MOP, 735,000 tons per annum, 1 million tons of salt. They have all-in sustaining cost Brazil of 168. The muriate of potash price of 412, which is obviously incredibly optimistic. 412 minus 168 times 735,000, 180 million. No, this doesn't get anywhere close to 307. I cannot see how they've got these numbers. If anyone can see how they've got these numbers, perhaps this involves SOP, but SOP is nowhere mentioned on this. I just can't see it. I don't know how they've got it. So I don't understand these numbers. These are the results. Basically, there aren't any results so far. It's a development. These aren't very interesting. So positives. If Shore Capital and Emmerson are right, this project has amazing economics with an NPV 8 of over $1 billion. And even our rough calculation, 66 million EBITDA, that's actually, compared to the current market cap, that's not too bad. But of course, obviously, you need to fund mine development of 400 million. So, what the multiple would be after dilution, we just don't know. Negatives. Well, the production price seems to be steadily rising, FOB in Casablanca. These are all numbers from historic presentations. Freight numbers, anything that this presentation I've been able to verify just seems wildly optimistic. Ratio of freight cost Vancouver to Rio divided by Casablanca to Rio, they're saying it's 3-to-1, whereas independent sources put it 3-to-2. And they're saying that toll costs in Panama Canal are $5 a ton, independent sources $2 a ton. Everything's just excessive. And the MOP price, CFR Rio, of $412, I mean, that just seems absurd, given that the current price free on board Vancouver for MOP is $202. And the market is oversupplied. I just don't understand why they're assuming that. And as we've seen, the Shore Capital numbers I can't work out how on earth they've got to over $300 million a year EBITDA. And also the project will require funding of 410 million, and shareholders should be expected to be diluted. But above all, the potash market just seems incredibly well supplied. So their assumptions, all their modeling assumes potash prices which are much higher than where they are now. Now, it may be that I have completely misread the prices they're assuming and I have missed something, in which case, please get in touch. And everyone who is interested in this should check back on the comments section underneath the video, because people do come back with very useful information, which we post under the comments section. And if I've got this wrong and people have information, please can you send it to us and we will post it there. Bottom line, I don't understand it. Richard.
Oh, thank you very much, Keith. A very well researched, interestingly researched report you've done for us. I have to say it's fascinating that you can pick up all this information on freight costs and so forth, yeah, and the Panama Canal shipping rates. Extraordinary. I think what you've identified is a conundrum, which is what are the correct numbers? And as you say, hopefully we'll get some comments that help elucidate exactly what's going on. But with so much sort of variation and inconsistency with the numbers, it does give the investment a bit of a health warning, doesn't it?
It does, yeah.
Until they're understood. And as you say, it is significantly reduces the potential upside whilst not making it necessarily a poor investment. It makes it a less good investment if what you've identified is correct. So yeah, let's have some comments through and see what other people make of it. Very interesting. Right. Thank you very much. I know you put a lot of hard work into this one, Keith. So thank you very much for doing that.
It's a puzzle, Richard. It's one of those things where you start digging and I just don't understand it. So yeah, because there is such a big gap between the numbers being put out by the company and the numbers that I think are reasonable. So, a long-term MOP price of 412 just seems mad compared to, the numbers we are seeing in the market.
Doesn't appear to have any basis, does it, from your research? Great. Well, thank you very much for doing that, Keith.
That's right. Well, thank you to Stephen for recommending that. I'm afraid you're probably not going to like this, but we do our honest best in analyzing these companies, and please keep on sending your recommendations through and we will take a look at them.
So if you enjoyed it, press like and subscribe. If you didn't enjoy it, press like and subscribe, because Keith put a lot of work into it and he deserves to be given the credit for the amount of work that he put into it. And we look forward to your comments. And until our next podcast, it's goodbye from Keith Jordan.
Goodbye.
And it's goodbye from me.
And it's goodbye from Richard Rita. Goodbye from Richard Rita, I should say. Bye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.